Something very strange is happening in the $1.8 trillion private credit market. Investors suddenly want their money back. And the biggest asset managers in the world are telling them, you can't have it. So what just happened? BlackRock just limited withdrawals in one of its private credit funds. Investors wanted to redeem 9.3% of the fund, but the fund only allows 5% liquidity per quarter. So BlackRock had to say, sorry, we can only give half of what you want. Half of you are going to get your money back. And at the same time, we saw Blackstone record redemption requests. Blue Owl had to sell assets to meet withdrawals. Private equity inflows from wealthy clients collapsed. And suddenly, investors realized something very, very important. These funds lend money to companies in illiquid loans. Illiquid loans, which means when everybody wants out at the same time, there's no exit door. Somebody's yelling fire inside of the theater, and there's one tiny little door for everybody who's trying to get out. And there is no exit door this time around. And why is this happening? The real problem isn't the defaults, because the default rates are extremely low. No. The real problem is a liquidity mismatch. You see, for decades, private credit was owned by pension funds, insurance companies, sovereign wealth funds. And these investors understand that illiquid assets require patience. But now the industry expanded into retail investors, wealthy individuals. And these investors, financial advisors, they behave completely different. When volatility rises, they panic first and ask questions later. So the most important chart that you can look at, for example, is a chart of the so-called business development companies. They are currently trading at 73 cents on the dollar relative to net asset value. And meanwhile, the private versions still claim to be worth 100 cents on the dollar. So the market is basically saying, we don't fully trust your marks. And here's my contrarian take on this. Now, there's an interesting part to this, because when Wall Street sees a problem, they don't run away from it. They financialize it. And that's exactly what you suddenly see. Here we see a wave of private equity ETFs. Private equity market ETFs. Why? Because these ETFs create so-called liquidity, exit liquidity for the institutions. So they allow investors to trade exposure to private assets without locking up capital for 5 to 10 years. So paradoxically, the stress that we're seeing in private equity right now may actually accelerate the ETF-ification of private markets. So what does that mean for us as investors? The big question is this the beginning of a crisis like we saw in 2008? Or is it the beginning of a new asset class going public, which has been trying to do for some time now? And history suggests something important. Whenever Wall Street opens a previously private asset class to the public, assets explode in size. You don't believe me? Yeah. We saw this with, for example, high yield ETFs. We saw that with real estate investment trusts ETFs. We saw this with CLO ETFs. So private credit right now might simply be the next evolution of the capital markets. But make no mistake, illiquidity always looks safe until everyone wants their money back. So this is very important. In markets, the biggest risk is never the asset itself. It's the liquidity you thought you had. So here's the trade potential. Currently, we're shorting Blue Owl Capital, Ares Management, Apollo Global Management, and Carlyle Group. But after this sweeps through the market, there's a long opportunity in BlackRock and in Blackstone. We learned this in 2008. Why? When liquidity stress escalates, the largest platforms will be the winners. In 2008, we called it too big to fail. Remember that. So follow me for some interesting institutional advice that actually will make you money. See you in the next reel.